Well, holy shit, the market has been chaotic, right? There's been so much coming out of the federal government and this administration with tariffs on, tariffs off, the 10-year treasury going up and then coming down, the 30-year treasury being at all-time highs. And it's causing a lot of chaos, especially within mortgage rates and the stock market. So there's a lot of volatility out there that's impacting where we're at today in the housing market. Hi, I'm Danny Brown. I'm the CEO of Myriad Real Estate Group, and this is going to be our June market update. So let's start with supply and demand as it pertains to the greater Phoenix area. So supply this spring has been increasing, which we normally see every single year. A lot of sellers wait until the spring to list their homes, knowing that the seasonality in Phoenix is the time to sell is the springtime. So we've seen that natural run up in listing activity. What we haven't seen is the natural run up in buyer activity. So the buyer demand has remained relatively low this entire spring season, and that has caused inventory to increase at a somewhat rapid pace, and we are now back to pre-COVID levels for our overall listing activity, which I'm framing it in a negative context, but it's actually a positive. We want more listings on the market and we want that activity to grow. And so the fact that we have had higher mortgage rates stifling demand has allowed that inventory to grow over time. So now when mortgage rates inevitably come down, buyers return to the market, it's not going to be as feverish where we start to see a repeat of home values skyrocketing at a pace that is unstable. So it'll be more of a balanced market. But right now what we're seeing is that increase in supply, stifled demand, and that's actually causing home values in some areas to come down off their highs. Nothing dramatic. So a crash is defined as a 20% or more dip in valuations. You know, what we're seeing is much, much less than that. So kind of low single digits in terms of home values coming down. And it's very area specific. So it's not everywhere across greater Phoenix is seeing that pullback. It's just in certain markets in certain areas. High supply or higher supply and lower demand is causing our spring market as we head into the season to be much softer than it normally is. What really ultimately kind of matters the most is the pricing and the demographic that home is attracting, right? So your entry-level homes are seeing a greater decrease in overall value than, say, your semi-luxury or your luxury homes. And that's because your entry-level buyer is much more affected by that initial cost than somebody that's selling their current home to buy their next one or just has a higher level of income. Higher level income people are able to absorb that increase in cost much easier than an entry-level buyer. So that volatility is definitely hitting that lower end of the market much more than your middle to higher end of the market. So with that being said, that creates a huge buying opportunity for those individuals that can afford to be in that entry level, kind of sub 500,000 for the greater Phoenix area. You have a lot more negotiating power with those sellers because the level of demand's just not there. So you can really beat them up on the purchase price, closing cost assistance, including buying points on your mortgage to help bring down that monthly cost, getting them to do repairs. Where we're seeing a lot of volatility and just not a lot of activity is really in the townhome and condo space. In that lower price point, there is very, very little activity taking place in the townhome and condo space. So there's great opportunity for entry-level buyers who may not be able to buy a single-family home, but those townhomes and condos are becoming more and more affordable due to that lack of overall demand. What we have seen is some volatility in mortgage rates. What's good is the gap between the 10-year and where mortgage rates are at has narrowed significantly. So when we're seeing this volatility in the bond market, we're not seeing as drastic of an effect on the mortgage rate market. So we're still hovering in that mid 6% range where we have seemed to be stuck for a very long time. those individuals maybe with lesser credit scores, they might be closer to that 7% mark, but you can still expect your rate to be somewhere in the mid sixes right now. With mortgage rates, we've seen a lot of catfighting between Donald Trump and Jerome Powell. And I theorized, at the beginning of the year, one of my predictions was that Donald Trump would fire Jerome Powell, or Jerome Powell would ultimately quit. Well, the Supreme Court has come out and ruled that Donald Trump, the president, cannot fire the chair of the Federal Reserve. So Jerome Powell's job is protected and safe from Donald Trump. Does not mean that Donald Trump is not going to make Jerome Powell's life a living hell. This is where the shadow Fed comes into play, and Donald Trump can nominate who the replacement for Jerome Powell will be. And of course, the media will then, want to interview that incoming Fed chair on what they would be doing in this case, right? So if they start coming out and stating that they are going to be cutting rates quickly to boost the markets, to increase liquidity, all of those things, that will have an effect on today's mortgage rates. We also saw a tweet come out where Donald Trump said he wants to remove Fannie and Freddie from conservatorship. I did a video on that and what that could mean to mortgage rates. I don't think that that's going to happen. I think that that was one of those late night tweets that Donald Trump tends to do just to feel out and see what happens if he throws this out into the ether. Because the adult in the room, U.S. Secretary of Treasury Scott Bessent, came out and said, if removing Fannie and Freddie from conservatorship would increase mortgage rates, they're not going to do it. So I think there's a high likelihood that if they did pull Fannie and Freddie out of conservatorship, you would see an increase in mortgage rates. So I do not think they will do that. And even if they did, it is something that is going to take years to unravel. It's not something that can just happen overnight. Scott Bessent is also trying to negotiate deals with countries all across the world. And Trump is using tariffs as leverage to get those negotiations going. So recently he came out, threw a tantrum and said he was going to throw 50% tariffs on all of Europe. Well, then he walked it back. I think that he did that because negotiations probably weren't going very well or taking too long. So he threatens them with the tariffs. They come back to the negotiating table, and so they delay them or they severely reduce them. Bessent also came out and said that removing tariffs or dropping them below 10% is also a possibility. Well, the bond market really liked that, and we saw the 10-year and the 30-year come down on that news as well. So there's a lot of moving parts. There's a lot of volatility. I do have a lot of trust in Scott Bessent. I do think he's the adult in the room. Very focused on increasing liquidity in markets, very focused on trying to get mortgage rates down. The head of the FHFA, Bill Pulte, recently came out and attacked Jerome Powell as well, stating that inflation is squashed. We really need to start considering dropping rates. So I think that you have a unified administration all going after one individual, trying to get them to reduce those rates. So we don't know when it will happen, but I do think that Jerome Powell will crack. He's done this before, right? He was the Fed chair during Trump's first presidency, and he acquiesced to Trump's demands to reduce rates back in 2018. I think he's going to do it again, and this year we could see 2 or even 3 rate cuts before the end of the year, which would therefore bring mortgage rates down some. So if you are a buyer in this market, what you can expect are a ton of choices, right? There are over 20,000 homes available for sale in all of Greater Phoenix. So you have options, which is great. You can expect for sellers to negotiate, for them to contribute towards your closing costs, for them to buy points so that your mortgage rate or what you pay on a monthly basis can be lower, for them to do repairs. So sellers are going to be very much more open to having those conversations where in previous markets they haven't. How long this buyer's market is going to exist, we don't know. But historically, most buyers markets are relatively short. We have been in a seller's market for a very, very long time, and we're not that far away from potentially being back in a seller's market. So we do know historically that buyers markets are finite in time. So if we continue to see these higher mortgage rates, lower demand, we are going to naturally see a decrease in home values. But I wouldn't let that necessarily scare you, because it's not going to be a substantial amount. We're looking at low single-digit potential losses. So why not bake that in today and be aggressive in your negotiations while you have the options and while the market is soft? And remember that you're probably going to be in this home for the next 5, 7, 10 plus years. And so what's happening today will not necessarily impact you as much. A prime example is if someone purchased a home at the peak of the market in 2006, 2007, when home values fell on average in Greater Phoenix over 50%, if they would have held on to that property for 15 years, they would have almost doubled their investment. So it's a long play, right? So don't let the volatility or the minor loss in value today necessarily affect your decision if you feel financially prepared to buy a home. The thing to remember is there are a lot of people on the sidelines. We talk to them all the time who are very rate sensitive, and we can look at home builders as a prime example. They have been doing great during this higher rate environment because they're able to get individuals mortgages below 5% and below 6%. And so we know that when rates get into that 5 to 6% range, we start to see a lot more activity and a lot of buyer demand or buyers come off the sidelines and into that housing market. So pay attention to those rates, because as we get closer to that line, we could start to transition from this great buyer's market where there's a lot of opportunity into somewhat of a seller's market, which will obviously decrease that opportunity that buyers have. If you're a seller, it's tough. There's a lot of options out there. It's taking longer to sell a home. So you're looking at 60, 90, 120 days. If you were a townhome or condo, forget about it. It is taking a long, long time to sell those properties. So one, don't have knee-jerk reactions, right? If your home doesn't sell in 2 or 3 weeks, it's fine. This reminds me of when I first got into real estate, and it would take 3 to 6 months to sell a home, and that's why realtors, when they take a listing, would sign a 3 to 6 month contract with sellers, because that's kind of normal. So if you're listing a home and it's just not going to sell that quick. Also, the days of listing high to negotiate down are over. I meet with a lot of sellers and I give them my pricing strategy, and they're like, well, can we list higher? Sure, but you're not going to sell. Buyers have more access to information than they've ever had before. They're watching, maybe my YouTube video or countless others talking about how it's a buyer's market. They have the power. And if they see that your home is overpriced, they're just going to skip it altogether, right? They're not going to view it. So you need to price appropriately. And in this market, that might mean pricing lower than where your neighbor sold 3 to 6 months ago. Right? So I've had several clients that have priced aggressively recently, and what ends up happening is the market sees that deficiency, and if you can get more than one offer on the home, which if you price aggressively, that likelihood is increased, you can then get those people to compete, driving the price up. So that is a solid strategy in a market where home prices are softening. Price aggressive on the front end. It's going to decrease your days on market. It's going to potentially increase the level of activity, creating a multiple offer situation. And it's just going to be a much better experience for you selling your home. So pricing it appropriately and probably below where your neighbor sold 3 to 6 months ago. There's a ton of rhetoric and market volatility out there. So if I said something that is no longer true, forgive me. There's just a lot going on. I still believe that home ownership is the greatest path to wealth in our country, whether we're in an inclining market or a market where we're slightly declining. It is still a safe, long-term investment overall. It is not a stock. It is not something that you buy in today and then sell out of tomorrow. It is something that, as long as you're going to be in that home for at least 5 years, is a very safe, long-term play, because again, you have to live somewhere. Why not own that investment and that asset, knowing that it's going to be worth more, in the future than it is today? If you have any questions or comments, please leave them below. Don't forget to give a like and subscribe, and we will see you next month.